All right, so continuing where we left off with this cross-exchange arbitrage, we can have statistical arbitrage with that co-integration with some of the formulas I showed earlier, Q position as well. Um, on it goes. This is another powerful one that I've seen on videos, but not like this level for different types of strategies. So you can see here, this is important. So depending upon this formula of the stochastic volatility inspired paramet- parameterization, we can see what type of strategies we should use. Do we use a butterfly? Do we use no negative variance or a calendar spread? Um, so again, moving into the duplier and the swapping for variance, and this again, it goes on and on using Fama French style factor decomposition, dynamic factor loading. Um, this is another popular one, principal component analysis. But this is important to know how to use it on the different types of parameters. So here we have a factoring of 60%, 15% variance on market factor, where all the coins move together. And if that's your thing to only trade crypto, you could do that. Bitcoin versus other alternative coins, a DeFi versus a CeFi, L1 versus L2 for all the different type of coins on the different blockchains. If it's level one, level two, league lag relationship, cross correlation, another important one. So this is really very valuable that you're not going to see anywhere else because the AI is so advanced. Knowing when to apply a futures or spot based upon the results of this cross correlation function. It's going to use spot future leads by one tick or the contemporaneous correlation, or use a futures lead spot by one tick. Like it not just shows you formulas, but when to use it, under what condition, and where to use it. That's the difference. Then we get the time weighted average pricing, not used as much. This is where it gets very interesting. If you're on a direct market access with all the proprietary feeds I talked about, here we have the enhanced with the volume profile, adaptive, target, participation rate, and so on. These are so many things that a lot of the smart money may not even use, at least the more amateurish ones. These are very deep level type of analysis that you can use. Implementation shortfall, okay? Urgency parameter, sniper liquidity seeking algorithm. And here's the basic logic of it right here in pseudocode. Smart out order routing logic. If filled, you route to a larger order. If not filled, you move to the next venue. So an alternative. So you can measure the conditions on when to trade something like Bitcoin. It's absolutely phenomenally advanced here, what you're seeing. Market making profitability analysis. So again, you can use something similar to a Kelly criterion. Um, at what point is it worth trading using market making based upon a profitable analysis, based upon gross P&L, spread, revenue, if there's any adverse selection. And again, right there, uh, when it's zero point 0.5, we only capture half spread per size. Not many people are going to talk about that. Using the Spooner model for Q positioning, optimal spread of the volatility, all of that here. Okay. And again, another key point here is we're using a specific data set over 2 days on a tick level. So that means here, this could change based upon different data and different criteria from the data. That's why I'm saying the data is always first when it comes to calculating this, forecasting it, and when to trade and when not to trade based upon the risk using these very deep analysis formula equations. Again, inventory based skewing. uh, using bid and ask itself and developing a skewness measurement based upon bid and ask. Okay. And here's something else. As this will change, as we get more tighter regulation in the future, which it will be, we can measure the risk of the regulatory compliance and risk controls. This is so key. If you want to make money and retain money in trading from an automated or even from a discretionary time point of view, the secret sauce is this. It's very simple. As I've shown in my introductory to this, a lot of people will always do the buy and sell or buy and hold forever. Okay. If you're doing this type of trading, you set a data time frame when you want to trade. You set um, a target, maybe over a 24-hour period, and you trade it. Once you hit that limit, you stop trading to retain those profit. And you can also set the same thing on your daily profit loss to minimize it as well. Here we have fat finger prevention, all the different scenarios that you can trade. And again, this is all high frequency trading right here. Secret stuff that you will not see most likely anywhere else, unless you're part of a group with actual traders that are doing this. Wash trading detection, spoofing, layering detection, all the questionable stuff out there. Now, again, we get into the technical nitty gritty here using formula or architecture, using the FPGA NIC board, kernel bypass, on top of user the space. And again, everything's nanoseconds now, not microseconds. That needs to be understood. Then we also have a strategy engine. Again, that's part of what's available in the C++. It's provided as an example here. So once you start seeing the time delay on the load for all of these processes, okay, I've got one article I've done on the right exact branded boards you'd want to use um, for HFT related, for optimal HFT to reduce your latency just based upon a specific type of FPGA board. Very expensive one, probably about 5,000-6,000 a piece, brand new. Here you can see typically where you'll spend time on the processing, market data, 200 milliseconds, order encoding, 150. You'll have your TCP IP stack and the wire to wire. Okay, everything's all about nanosecond. That's what we're trying to get down to. Okay, so here we're using other techniques, and it can be a blend of C++ or 100% C++ using the DPDK library, open source, or 100% FPGA as well. And some firms will use a blended approach between the two. So we have here, as I said, the DPDK. That's a Linux um, framework available open source from Intel, Open Onload, Solar Flare, and Xilinx Alveo. So these are specific hardware that's recommended. You can look at the different types of software options we have here. We use FPGA, Verilog versus VHDL, C++, C++, Rust, Python, Java, and the like. And again, here we have all the different memory allocation, all the tools that are available. That's a whole nother world that we can get into. So here's the analysis from the AI on how to approach using this specific Bitcoin tick data over 2 days for this particular Bitcoin futures contract. Doesn't even look at um, options at all. It's just 100% pure futures. So it's doing the calculating here for you, and looking at and grading the signal potential out of this. So we have here a time frame over a second, price range, okay, and the spread, and it gives you a measurement on the directional um, sentiment. So here we have a strong buying environment, and the signal is going to calculate the long bias over the next 30 minutes. That's how deep this is. And we can also measure the liquidity as well. Same time frame, expansion observed on the spread. We have low volume over millisecond. And The thing is with this, with something like C++ or even FPGA, you can measure this on the fly. And I think we're going to get to a point with MCP, RAG, all that neat stuff that you'll be able to do this on the fly and have different models adjust to the market, what it's seeing, and adjust to that approach on all levels of your trading based upon what the data said. Here we have institutional accumulation here. Pattern could be higher, low, consistent buying. It's elevated on the VPIN. The signaling is positioned on the breakout signal and the volatility clustering. Okay, this is I've seen this before. And then, as I said, this is now using Claude 4 or 5. This is just now the basis with where you can take other models that I'm not going to mention that are much more sophisticated than this. And based upon your prompting, you can make it more sophisticated and develop code and modeling to change the automated trading on the fly. Like we're probably at that point. Sure, it's already done in advanced, more high uh, places. We just don't know, but the potential is there. But we could see here, just alone on the volatility clustering, we're looking at this time frame on this day, price range, 1,000 point spread. We have different patterns here we could use. So it's signaling on the time frame when you use mean reversion with tight stops, and it's telling you that on the go. Just one data set snapshot on what can be done here. Okay, so here's an example of what you could put into your system at an ultra low latency level, just on Bitcoin. Remember, Bitcoin's very liquid. Um, I think it's going to get more sophisticated as time passes, as long as Bitcoin stays relevant in the markets compared to other instruments as well. So I don't know what the future holds there. Part of it's the stable coins that are kind of affecting Bitcoin and breaking down the historical cycles and patterns that we're used to with Bitcoin because of stable coins that are becoming more mainstream. And the thing with Bitcoin, the history of it is that Bitcoin was not just for speculation, but also for utility. The Bitcoin's no longer utility anymore, in my view. It's going uh, the utilization in the world, quote unquote, of cryptos coming out of stable coins, the USDC and Tether. So here again, looking at all this, the trading system generally, where you can have it spit out a output based upon the data that I'm providing, where we have all the different features calculated here, and this is using now um, standard technical analysis, the RSI, rate of change, VWAP, blah 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 blah, and then we can calculate a regime change, get a machine learning signal, and this is using XGBoost, in case you don't know that. Um, Technical filters, again, the trend, momentum, the microstructures, like I've already mentioned here, and the different parameters you can use to calculate your raw signaling. Okay. Okay. And then again, you get your risk adjustment as well and the return potential as well based upon what you're seeing. And again, I think we're going to get to a point where we're able to do this on the fly in real time. So again, the final synthesis, data edge technology, again, co-located in a CME exchange like Aurora, FPGA, kernel, bypass, blah, 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 analytical on the different type of modeling, execution edge, which you need, and you need the risk edge as well to stay ahead of these type of firms. So here's what it's saying. While retail traders may implement simplified versions, to do this properly, you'll need a $10 million technological infrastructure investment. You need 10, a team of 50 plus specialized engineers and researchers. You obviously need to focus on the regulatory and the optimal years of refinement for this. So all of this in this one document, okay, the formulas, the frameworks, technical techniques presented here, it's state of the art in quantitative trading because of AI. And look what it could replace if I kept going and going deeper and getting better coding for all these different scenarios. This is what it would cost. $10 million investment and a team of 50 people. That's where we're at. All right. So we'll leave it at that. Thanks for watching for now.